Welcome to Wealth Master. Today, we're diving deep into the insights of one of the world's greatest investors, Warren Buffett. I've read everything written by him, and today, I'm going to share with you the key lessons that truly stand out. These are lessons that can change the way you think about investing, business, and even life. Let's begin with something Buffett talks about a lot, the circle of competence. Now, what exactly does that mean? Imagine the stock market as a vast, unpredictable landscape. When you invest in a stock, you're essentially betting on a company's future. Since the future is unpredictable, you want to place your bets where you have the highest chance of success. And that's your circle of competence, the industries or companies you deeply understand. These are the areas where you can make smarter, higher probability bets. But here's the key. It's not just about knowing everything. Buffett himself has said that while it's important to have a large circle of competence, it's much more important to know where its boundaries are. You don't need to know about 100% of the stock market. You can make massive gains by only understanding 5%. So how do you find your circle of competence? First, think about what you consume every day. If you drink Pepsi regularly, you probably know a lot about the product, the competition, and the value it brings. Next, think about your education. Did you study software engineering? Then you likely have an edge when evaluating companies like Adobe or Autodesk. Also consider local knowledge. If you're from the US, you're naturally going to have better insights into American companies just by growing up surrounded by them. And finally, think about your job. What you do for a living can offer special expertise in specific areas. A career in social media or finance, for example, might give you unique insights into those sectors. Now don't stop there. Your circle of competence isn't something static. Buffett has spent decades expanding his own circle, investing in a wide range of industries, from insurance to railroads to tech. But he doesn't just invest anywhere. He looks for companies with durable competitive strengths, strong management, high returns on tangible assets, and fair prices. That brings us to the next key point: the relationship between interest rates and the stock market. Interest rates act like gravity on stock prices. When rates are low, stocks rise. When they're high, stocks fall. It's not just about whether a stock seems cheap or expensive. It's about how interest rates affect that valuation. Here's a quick analogy. Imagine lifting weights on the moon. The weight would feel much lighter because gravity is weaker. That's how low interest rates can make stocks seem lighter and easier to lift. But when rates go up, stocks suddenly feel much heavier, much like trying to lift weights on Earth. Right now, stocks are feeling the weight of higher interest rates. To really evaluate if stocks are expensive, investors often use the PE ratio, which shows how much you're paying for every dollar of earnings. A stock with a PE of 20 means you're paying $20 for every $1 of earnings. The inverse of this is called the earnings yield, which shows how much return you get for every dollar invested. When stocks offer a higher earnings yield than bonds, they might be considered cheap. But right now, with interest rates being higher, the opportunity cost of investing in stocks is also higher. That's why, according to Buffett's philosophy, if rates stay this way, stocks could seem expensive for a while. Now let's talk about a controversial topic in the investing world: share buybacks. Share buybacks are when companies repurchase their own shares, which can be a great way to return capital to shareholders. But Warren Buffett has been critical of how most companies handle them. His main argument? Share buybacks only make sense when they're done at the right price. Yet, many managers fail to consider whether they're paying too much for their own stock. For example, McDonald's has consistently repurchased shares over the last 15 years. But was the company undervalued for all those years? Probably not. Buffett's approach is different. Berkshire Hathaway rarely repurchases its shares, and only when they're trading below a certain threshold of intrinsic value. That way, continuing shareholders always get a fair deal. It's a perfect example of how discipline and patience lead to better results. Finally, let's explore one of the most personal lessons Buffett shared with his close friend, Bill Gates: time management. Bill Gates once had an incredibly packed schedule, filled with meetings and travel. But Buffett, he ran one of the world's largest companies with far fewer meetings. Gates was so impressed by Buffett's approach that he started simplifying his schedule too. What Buffett taught him was that saying no is an important part of being successful. Buffett doesn't equate busyness with success. Instead, he believes in carving out quiet time to think deeply and make important decisions. That focus, that ability to prioritize, is crucial whether you're building a business or managing your investments. So those are some of the most valuable lessons from Warren Buffett. Insights that can transform the way you invest, manage time, and make decisions. Remember, your circle of competence, understanding interest rates, wise share buybacks, and managing time well are all key to long-term success. If you enjoyed today's video, hit the like button, share it with others, and subscribe to Wealth Master for more powerful insights into wealth creation. Thank you for watching, and until next time, keep mastering your wealth.